Yeah, thanks so much, and also thanks Kuan Zhi for also providing a introduction into the topic today. So my topic today is to provide a deep dive into the outlook of the global semiconductor industry in 2021. I'm Terence, a Senior Research Analyst at Phillip Securities Research. So without further ado, I'll just cover some of the content that we have for the semiconductor industry today. That's quite a bit. So I'll just bring you through slowly. The first is a synopsis of the semiconductor landscape. We also provide just a brief overview of the business model of the semiconductor industry. Again, some of you all may be familiar with the industry already. So just bear with those who may not be so sure. But the focus of the semiconductor industry today is to focus on the foundry semiconductor market, because it's quite as some of you know, the semiconductor market is just too big, so it's impossible to focus on everything. So for us, the focus today is on the foundry market, and that's where we see the most growth taking place. So we cover the foundry total addressable market in 2025. We also present a house view on the industry-wide semiconductor capacity shortage, which we believe will last till 2023. The capacity and ramp-up schedule of each foundry player. And then we also going to show you all some of the winners and losers that we see in this current landscape as well. We also introduce one of the stock pick concept, also the rule of 40 analysis. With elaborate a little bit on this, and also how to gain exposure into this sector if you all want to. And then we'll just end with some resources that you all can turn to if you all want to get more information on this. So like what my colleague Kuan Zhi mentioned just now earlier on. Also, I think the for some of you all who are where the semiconductor industry is seeing a worldwide shortage in terms of the chips industry. So we just provided some articles here for you to see how the global chip shortage is affecting the real world. So you can see here in this some of these pages what the reason why the world is seeing this chip shortage is because of the COVID-19 pandemic. We've seen really a surge in demand for all the automotive and also all those smartphone devices. So this has resulted in all the foundry players reporting a shortage. In fact, they cannot supply some of these. In fact, some of them are actually expecting maybe even beyond 2023. So before we carry on, one short poll here. For you guys, so for those who maybe are already a bit more aware, also give me some understanding of how in tune you are with the semiconductor industry and how I should do the presentation. So there's one question here: when will the supply shortage in the semiconductor industry? And of course, if you don't know, don't worry about it. But for those who think it will be 2021, maybe you'll just put 1 in the chat. If you think it's 2022, you'll put 2. 2023, put 3. Of course, that's what CNPC and most of them are saying also. Then, of course, if you think it's beyond 2023, then plus put 4. So let's just get a sense of what you think it is. So I think thanks. We think quite a number of your put. It seems like some of you are putting 2023, 2022 as well. Some beyond 2023. Yeah, I think the bulk is saying 2023 and beyond. Yeah, thanks for this. That really I think we're getting quite a lot of responses to, and this really show that you are really very very aware of this this as well. So thanks for this. We'll go on with this. So I think the bulk of the responses show that most of you all believe that the supply shortage will last beyond 2023, and for good reason, because that's also what we think when we show you why. But before we go into this, we talk about the business model of the semiconductor industry. So this is a bit blur, but that's just to let you all know. So the primary stage of the semiconductor industry, where they derive all the raw materials and components, all this silicon and silicon carbide, is what we call the foundry business. So the semiconductor industry may sound very complicated, but actually what we do is split it into just 3 to make it easier for you to understand, which is the foundry market, and then the fabless, and then the integrated device manufacturer. So for those who are not so aware, maybe the foundry market, what they do is the most basic level of chips, and then those who of course, at the other end of the spectrum, we got the integrated device manufacturers, or the IDM. So this IDM do is really like what we put here, in charge of designing and then the manufacturing of the integrated circuits. Then the foundry, they focus on the semiconductor wafer manufacturing. So we go to the next slide. Yeah, so really primarily three semiconductors, but you get three business models in the semiconductor industry. The foundries, which is our focus for today, they are not involved in the designing and the selling of the semiconductor product. So what they do, they provide those chips that go behind the glass screen of your smartphone. So they don't go and compete for the customers. In fact, some of these foundry players, their main customers are like Huawei, your Apple, for those guys. So because they don't compete for the customers, they only do the chips. The foundry model has seen a rising traction in the last 10 years. We'll show you some charts slightly later. And the foundry revenue share in the overall semiconductor market has also been rising in the last few years. So because of the rise in the popularity of the foundry model, some of the key players that in the past they wouldn't consider going into the foundry market because they just think it's just maybe a bit low end for them, but some of them like Intel and Apple have started to explore going into the foundry market and already announced plans to do so. So our next slide, we show the world semiconductor industry. Why is interesting to us? You can see the world semiconductor industry growth actually accelerated to 8.4% growth in 2021. Again, why is it expected to accelerate to 8.4%? Because for the COVID-19 pandemic, the surge in demand for all these products really give a very heightened expectation for the semiconductor industry. So even though we are only halfway through 2021, I think the growth is still expected to be 8.4% from 2021. And you can see this accelerating from the 5.1% even in 2020. So for 2021, we're still expecting the growth. But where will the growth come from? So we look at some of the historical growth. If you look at the 10-year CAGR for automotive, is the fastest. And why automotive is the fastest? Because they talk about all the smart automotive vehicles, autonomous vehicles rather. So there's a requirement for a lot of chips there. The wireless comms also led to a lot of this growth. But later we show you why going forward the growth is not really in this kind of wireless or industrial applications, but really in what we call the high performance computing. So that is going to drive the growth in the semiconductor industry going forward. The semiconductor industry, we believe, will be driven by this mega trend of 5G and HPC. HPC is a high performance computing related applications. So these 5G and high performance computing related applications will fuel stronger demand for advanced technologies in the next few years. Why high performance computing, especially because all these are related to those artificial intelligence rather. So if you want to do companies who are investing in artificial intelligence, what they have to do is we have to use those those 3 nm or 5 nm chips. We'll come to slightly again to what those are later. But you can see for 2020, in terms of revenue growth and how we derive this, we compile all the revenue growth in the different industries. You can see the high performance computing had the highest revenue growth in 2020, followed by IoT, your Internet of Things, and then the smartphone obviously also which is the main driver. Actually is just 3%. For some of you all who are following this industry, you all may know the smartphone industry is the one that has shown the strongest growth. But obviously sorry for the disruption. I'll just continue. So COVID-19, like what we mentioned, has fundamentally accelerated the digital transformation, making semiconductors more pervasive and essential in people's lives. So what we saw from COVID-19 is the demand for all this kind of technology has really increased. So we don't expect this trend to change, especially in the next few years, because people are now more aware of how to use smartphones and technology. And of course, during the lockdown, I think people realize smartphones are very, very important. But in our view, the high performance computing will be a key growth driver, at least in the next 5 to 10 years, taking over smartphone growth in the next few years. And so for us, we see a wider application and faster adoption of this 7nm and 5nm technology, which will drive this continued demand growth. I understand that this can be a bit complicated. Let's try to simplify this. So what is this 7nm technology? So basically what it does is this chipsets, when you move from 7nm to 5nm, this will improve the logic density, the speed, and the power consumption. So basically, that's faster and better. And can, when you move from 7nm to 5nm, you can also allow for greater adoption to wider applications. So when you move to 5nm, also then it allows for greater utilization for artificial intelligence. We put here data centers and advanced driver assistance systems as well, high performance computing, 5G communications, and smartphones as well. They haven't, of course, they haven't gone into 3nm yet. I think the plan to go into 3nm is probably maybe in 2022 or 2023. 2023, we expect it could be the later part of 2023, the early part of 2023 as well. So these advanced nodes will really drive the foundry's demand. So TSMC now began producing the 7nm technology in April 2018, and has seen, yeah, sorry, some facing some technical issue, but should be better really. We apologize on behalf of everybody. So like you all see here, sorry, I didn't know that you all didn't manage to see, but the 7nm technology is the technology that TSMC started producing. Later we'll show you some of the key players producing the 7nm technology, and then the key players that will go into 5nm and 3nm technology, which is the more advanced node. So not anybody can do. In fact, even your those players were very experienced in the fields, like your Intel may not be even be able to produce this 5nm. So maybe for the benefit of those who miss this, let's repeat how to see this 7nm to 5nm. Basically, what it does is when there's improved logic density, what it does when you move from 7nm to 5nm is that it will improve the logic density, speed, and power consumption. So what it allows these end producers to do is they can expand this to wider applications. And what specifically, I think we listed some of these down here. It allow for utilization for artificial intelligence, data centers, then advanced driver assistance. This is your autonomous vehicles, high performance computing, of course your 5G communication, and also the for smartphones as well. Of course, earlier we mentioned the production of the 5nm process has already begun in 2020. So we are already starting to produce this 5nm, but currently only 2 players produce this. We'll show you a slide on this later. Only 2 players produce this. They are TSMC and Samsung Electronics. So you can see in the world, not a lot of firms can produce this. In fact, only 2 firms can produce the 5nm technology. Of course, Intel is trying to go into this space, but at the moment only TSMC and Samsung have the technology to do the 5nm. Of course, and the 3nm nodes are slated for mass production in 2022. We think that may be a slight delay because of the some of these production delays that TSMC is facing. We'll go deeper into the individual stock picks later for them. So that's a little bit brief, but that's very fast. So in this slide, we show you some of the key players at the different process nodes. You can see the 32nm and the 28nm technology, because these are obviously, when you compare the 32 and the 5nm, the technology requirement for the 5nm one, just to understand, make it simple, is of course much higher. So you can see for the 32nm technology, you got some of the key players. Of course, there are more, but we listed down the key main players. You have Intel, you have SMIC, IBM, GF is Global Foundries, Samsung, and then TSMC producing the 32nm one. Of course, you got a slightly more advanced nodes, which is the 22nm and 20nm one. And you can see, actually, if you just look at, if you take a step back, look, you can see it's like maybe like a downward slope. When you move to the more advanced nodes, the number of players in the industry start to become lesser and lesser. So you can see for the 22nm one, only Intel, IBM, Global Foundries, and you can see some of the more consistent names, Samsung and TSMC, obviously producing the 22 and 20nm nodes. Then for 16nm and 14nm one, again, some of these, but then you have UMC in this space. Again, some of you, just to preempt any questions, some of you maybe how come they compete in different nodes? Again, it's in-house capability and what kind of skill sets you have to be able to produce at which space. So if you don't have the capability, then very unlikely you will be able to go to the more advanced nodes. Of course, they can invest in Capex, but then for such investments, what usually it will take in the semiconductor industry, those who are in the semiconductor industry, you should know, it will take about at least 1.5 years to 2 years to build even higher capability one. And that's what Intel is trying to do. So in the 10nm space, you have Intel, SMIC, Samsung, and TSMC. But when it comes to the 7nm space, then you can see it's only Intel, Samsung, and TSMC. And then the 5nm and 3nm, we put Intel here. But also that's to point out the Intel is not yet producing here, but they intend to. So Intel is a potential entrant in this 5nm and 3nm space. Again, the 3nm space, if you all see, look at the slide below. I don't know if it's a bit small, but you can see the production is slated in 2022. But when they produce in 2022, the expectation is that it will be just these three players, Intel, Samsung, and TSMC. So the growth drivers in the next 3 years will really be in the 5nm and 3nm space, the revenue contribution here at least. Again, so this leading edge technology will continue to drive the growth. And for us, when we pick the winners, we look at who got a foothold already in this leading edge technology. And for us, at this moment at least, is these three players. And the high performance computing will be a key driver in the next few years, surpassing smartphone growth. Smartphone growth, obviously, in the last 10 years is the fastest growth. But of course, going forward, we expect high performance computing to be the key driver. At this moment, we see a duopoly market. For Intel, we come slightly later, but we at least at this moment is a duopoly market at the 5nm and 3nm process nodes, which will drive the ROE growth. They're expecting over 20% ROE growth for some of these players. So we also see why we like these players, because we see strong barriers to entry. Again, like what we mentioned, it's not, of course, not saying that those SMIC cannot even go to 5nm or 3nm, but you need a lot of capital, R&D, and then your talent, and then your customers need to believe that you are able to produce at these nodes. Otherwise, it doesn't help as well. So you can see it's not just about spending money, but you also need to have all this R&D and the customers to, like your Samsung or your Apple or your Huawei or even Tesla, to believe you. And then, like what we mentioned here, Intel is a potential entrant to the foundry services, but meaningful contribution, at least at this stage, we believe it will take time. But of course, if they can fix their manufacturing problems, which they have in the last few years, then this will be positive for them. Of course, one of the concerns in the semiconductor space is because all the foundry players are announcing record Capex. So the question then is the concerns over whether there'll be over capacity in the foundry space, which has happened before in the past. Because what happened in the past, the foundry players, everybody just ramp up on Capex, then you have this over capacity. And then what happened is the prices, the ASP or the average selling prices of your chips actually plunge in the next few years. So what we did, we tried to do an estimate for ourselves to see if this over capacity issue will pan out in the next few years, especially because you see when you look at TSMC, they're spending 100 billion in the next 3 years. All the other foundry players all announcing record Capex. So what we have here is the estimated. So if you look at the chart here on your left hand side, let me just bring you through the 2021 advanced node revenue is $36 billion. Estimated for 2021, and then you see here the incremental foundry revenue here. This 16 billion is what the foundries, or at least our in-house estimate of what the additional Capex that they will spend on will bring in terms of revenue, which is $16 billion. Just to for those who just for the benefit of those who don't know, for us we define advanced node revenue as those below 28 nm. So if don't know if I can go back to the previous slide. Sorry. Yeah. So anything below here, the 28 nm space here, we define as advanced node revenue. So anyway, so going back to this, the incremental, we see the incremental foundry revenue at 16 billion. The Intel has also announced they will go into outsourcing. So, but even when they do outsourcing, they do the foundry. They start to go into foundry. They also outsource some of the basic chip material. So we see 4.5 billion as absorbed by Intel's outsourcing. We expect $4.5 billion to be absorbed in additional capacity to be absorbed by 5G smartphone. And then Nvidia, AMD, and XL also to absorb about $5.5 billion dollars in the additional foundry demand, and then $1.5 billion to come from others. They are very small here. But I think what this chart is trying to show you is that that of course there are concerns. Everybody spends so much money, will it be overblown? Something like the gloves manufacturing industry. Everybody, during the COVID-19 pandemic, everybody ramp up capacity. Will there be an oversupply? But for us, when we look at the demand in the next few years, we think that's very unlikely, because the demand has even the incremental foundry revenue that is coming on stream, and this 16 billion, we also want to caution, may not even be able to realize it because of all the COVID-19 disruptions to manufacturing. So even though they are very aggressive in ramping up the supply, they may not be able to ramp it up completely also. I think my main point, if you realize, is that even as the players ramp up capacity, the demand still outstrip the supply. So in fact, we expect the supply shortage to last, even for us, at least beyond 2023. And like what we mentioned here in this slide, here, supply capacity will take about 1.5 years to build. So 1.5 years, it's not like, oh, today you want to do. It's not like, also just to compare, I mean, it's not really a good comparison also. It's not like gloves manufacturing. Glove manufacturing for the industry, you can actually just 6 months you buy the land, 6 months if for those players in the industry that have been doing it for a long time, like Top Glove or those guys, they can do, but 6 months they can do it. But for foundry, you at least need 1.5 years to get the demand, the capacity up. So what that means is they cannot ramp up the capacity immediately. It's a little bit more supply inelastic in terms of the supply of the chips. So the chips will continue to remain more expensive as well. Of course, there are some concerns also about the ongoing geopolitical tension, whether this will lead to the import and export restrictions, whether it will prolong the supply shortage. We think yes lah. But of course, under the new president, they even though there's still some of this, but it's elevated at least lah. So again, the demand, what we see here is the restrictions placed on SMIC in 2020 by the Trump administration actually worsened the supply shortage in the industry. So what happened was of course when they restrict the supply of the chips from SMIC, then this actually worsened the overall chip shortage in the global market. Of course, SMIC is trying to ramp up supply now, because of the previous restriction placed on them, they find it a bit difficult now to also try to ramp up. So this is what happens when you have this kind of trade war. So this slide here, we provided a quote. I'm not sure if you can see here, but so when we attended a call by TSMC, the TSMC president and CEO actually say, we expect the customer, maybe just read out, we expect the customer, almost all of them, to prepare a higher level of inventory. So again, one of the reason why this semiconductor shortage is not going to end so soon is because all of them are preparing for a higher level of inventory. Basically, why? Because they're just stocking up. So that is because of today, geopolitical tensions continue to persist, and we do expect them to prepare a higher level of inventory. So he actually made this statement in their most latest first quarter 21 results. So you can see that for all these players, even though for them, they're not even just booking what they need, they are actually booking ahead of schedule. So of course, the question there is there a possibility of inventory correction, because all of them are overbooking, but because we think that at least when we speak to them, the way management view this is they see their customers all overbooking now. They don't see them reducing their inventory supply. So for some of those players, they actually managed to stock up, like Toyota, all those guys. Toyota actually managed to stock up. They actually managed to draw in increased revenue, because they are able to deliver on their commitments. And those who cannot get the chips, obviously, your revenue is going to be impacted. So again, a bit of a rehash again, but again, we expect the supply shortage because of all these issues to last at least beyond 2023. Now, the next slide, we show the elevated Capex also to support the demand growth. I think again, all the foundry players already, they see, for them, they have a front row seat. So they can already see how the industry Capex, the industry shortage will last. So you can see here we provided a chart on the foundry Capex, at least in the last 5 years, and then we also provided the chart on that to show the forecasted growth. You can see in the last few years, of course, is just about about 10 B, but of course, in the next few years, they expect this to be about $30 billion, at least for TSMC. TSMC, you can see when you look at 2050, the chart here on your left-hand side, sorry, in the last 5 years for TSMC, they spend about 10 billion on average every year. Then some of the other, of course, TSMC is the most aggressive. You can see the UMC, SMIC are a bit small. But for 2021, they expect to spend this year, and 2022, 2023, they expect to spend about 33 billion in total for TSMC. So you can see really a surge in the foundry Capex for the next 3 years. So for us, we provided some figures, 3-year forward CAGR. For this number here is for the whole industry. Is expected to increase, not just TSMC, to increase to 17.1% from the historical. So when we do the historical, we just do 5 years. Historical 5-year CAGR of 13.1%. So even though the last 5 years already got elevated Capex, but the next 3 years are expected to be even higher. So again, all foundry players have guided for higher Capex spend in the next 3 years. Again, the chart here. Then TSMC, the world's largest semiconductor foundry, already committed to spend $100 billion in Capex over the next 3 years to alleviate the shortage in the industry. And then some of the three big players, TSMC, UMC, and Global Foundries, have guided for capacity shortage. This is their view to remain beyond 2023. At least that's how they look at the industry now. In terms of the foundry market, who is gaining the most market share for us? Okay, if you look at the table here on the left-hand side, you can see the market share of some of these players. You can see we provided for the last 5 years. So you can see the biggest market share in this space is TSMC. They own almost 55% market share. They have been growing it. And the reason why TSMC have been able to grow their market share also at the expense of, say, Samsung Electronics, which is the one in orange here. The one in black is TSMC, in case it's just too small. Then the one in orange here is Samsung Electronics. So you can see the reason why TSMC is able to grow, because they are the ones who are most aggressive in being able to move into the 5nm and 3nm space, and the 7nm rather and 5nm space. So for going forward, we expect TSMC's market share to actually increase even to 60 to 65% going forward. Why even higher, and take market share from the rest of the foundry players? The reason why, because they are expanding very aggressively into the 5nm and 3nm space. And this one, some of the players, they cannot even do that. Yeah, so maybe the chart on the left hand side is a little bit it's not so clear, but then we provided a pie chart here just to show your TSMC's market share, 57.1%. Of course, Samsung Electronics is 18.5%, and then United Microelectronics 7.5%, and then the rest again is this 16.9 is a very fragmented market space, so no point breaking it up also. But the rest take up about 16.9% of the market share. For us internally, when we look at the forward view, we expect this to TSMC can at least reach 60 to 62% by 2023. So that's our base view. Yeah, and Intel is building its own manufacturing capability to strengthen the capability in advanced manufacturing. But so what Intel has done, of course, what Intel realized over the last few years is their manufacturing capability. Their manufacturing has been very adversely affected in the last few years. So what they want to do now is they want to try to go into advanced manufacturing. So their new CEO is talking about going into the advanced manufacturing, and so on. They want to ramp up capacity So I think first the news, Intel announced plans to spend $20 billion to build 2 factories in Arizona. So they also announced that they are not sure yet, but they may announce further plans to build additional capacity in at least in the US, to build additional fab locations like in the US and Europe later in the year. So for them, if they can build in the US and Europe, then obviously this will at least allow them to have more control on the fab capacity as well. So for Intel, where they're at now, they're currently shipping chips with 10 nanometer transistors. Obviously, they want to go into the 7 nm and the 5 nm space. And their aim is to catch up with the TSMC and Samsung Electronics on the 5 nanometer transistors, which is the leading edge of process technology right now. But for us, when we look at this, we see the capacity ramp, even from Intel, even if Intel ramp up their capacity, we don't believe that this will be able to alleviate the immediate supply shortage in the market. And the reason why is because again for Intel, they will take at least 2 years. In fact, they're expecting any meaningful contribution from Intel, even if they start shipping out in 2020. Any meaningful contribution in terms of supply contribution from Intel will be 2023. So this is going to take this will take longer than what it is now. We broke it down into the different industries into this slide here. That maybe I'll just elaborate. For us, we see some of the key winners, the fabless foundry and semiconductor equipment supplier to benefit the most. So we listed these 3 down. There are more, obviously, for those who are aware. There are more, but we just listed down those that we think is the biggest beneficiary of the chips. So that's just to for those benefit of those who don't know, we just show elaborate. The integrated device manufacturer, what they do is that they design their own branded chips in-house, and some of them also own the fabrication plants where they manufacture their own integrated circuits. So some of the key players who do IDM, so IDM means you design your own chips and you also actually produce. So like Intel, Samsung Electronics, and NXP as well. For the fabless players, they design and then they sell semiconductor chips while outsourcing their fabrication to a foundry. So some of these big, you can see the big names here like Nvidia, AMD, and then Qualcomm as well. So how they do is they design, but then they outsource this fabrication to say like TSMC to actually produce. Of course, that's again just to elaborate there's some overlap. Of course, we can't really show all the overlap, but this is where we think they fit. And then of course the foundry players, which is the main focus of our presentation today, of course, operates the semiconductor fabrication plants. It focus on manufacturing integrated circuits for other companies. But what these guys do is they don't design. They just produce for some of these guys like the fabless or the IDM players. Of course, the IDM players some of them also want to try to go into the foundry space. And then the semiconductor equipment supplier, basically what these guys do is they manufacture equipment used in the fabrication plants and semiconductor facilities to design and develop semiconductor chips and components. So some of the key players in this industry, like what we say is ASML, Applied Materials, and Lam Research. Again, some of you all may have questions, or maybe some of you are just joining, but some of you all may have questions on some of these individual companies. We'll elaborate more on these companies later at the back part of the presentation. So if you have questions also, just feel free to put in the Q&A. We'll try to answer them later. In short, the foundry Capex is expected to remain elevated for the next 3 years. And then you can see where this is going to come from. So you can see for foundry, the growth is expected at least to expand going forward. Of course, this Capex just show you a breakdown of where it will come from. Yeah. So next slide. Again, we have a poll. Again, we just put it here, even though there's a poll, but that's just to get to get your view also. Which is the most important determinant of the share price of a company? The reason why we ask this question is because we are going to introduce this concept, what we call the rule of 40, in analyzing companies. So we come shortly into what the rule of 40 means. But before that, we want to ask, what is the most important determinant of the share price of a company? So what do you think is most important for share price of a company to grow? Is it number one, is it revenue? It means when there's revenue growth, then the share price of your company will go up. Or do you think is EBITDA growth? So EBITDA means the earnings before interest, tax, depreciation, and amortization. So basically what it does, it does show the earnings before you pay all this interest and then your tax and depreciation. That or is net profit the most important determinant of the share price of a company? So is net profit, the net profit, of course, is what the company earn after all the paying all your operating expenses, your costs and everything. Or do you think it's book value growth? So book value growth means you're able to grow your through your ROE and grow this over time. So maybe I just pause a while to just see some of the responses from your. Again, those who responded, thanks so much. So I see here the responses are quite mixed, but we have revenue, we have EBITDA here. Some of you say book value. I think the bulk of your feel that it seems to be revenue and net profit lah. And we have one comment here from one of the participants also. Maybe I just read out. Early stage revenue growth, then maturing companies, then EBITDA growth. Yeah, thanks for this. It's quite good. Yeah. Yeah. So that's a good point. Yeah, I think we have a lot of those who so the responses is quite varied. Actually, when we look at the responses, I think most of your feel is revenue, and then also some of your feel the bulk of actually, okay, I think the majority of the responses seems to be on EBITDA actually. Yeah, so your belief EBITDA will be the highest. Okay, so I think without holding back, let's go on. So we introduced how when we're going to the stock picks, but just before going to the stock pick, we just want to talk a little bit about what the rule of 40 is in terms of stock picking. So just why rule of 40? I think for those who have experience investing, you know that the traditional stock picking tools that investors use are like your price to earnings ratio, your price to book ratio, PE, PB. This one we provided here. This in this table here, and then of course the dividend yield. When investors look at REITs, for example, or maybe even some of the banks, they all look at the price to book and the dividend yield as well. And then there's some investors also look at the price to sales ratio. I think that we had one participant earlier who actually say, yeah, you know, when you look at the some of these growth companies, definitely need to look at sales. The EV to EBITDA metric is also a very popular metric that some investors look at in terms of the valuing some companies. And then what most analysts would do, at least from the research team, we do a discounted cash flow model. So just to elaborate a little bit about what the discounted cash flow model do is for the discounted cash flow valuation model. What we do is we do a typically from the research team. What we do is we do a 3-year to 5-year forecast of the revenue and the earnings and the cash flow of the company. And then what we then do is to apply a discount rate to discount these earnings to the present value of the company today, to get the fair value, or what we think is a fair valuation of the company. Maybe like we do a discounted cash flow of say capital or capital land, then we get a fundamental value, and then that would be what we think is the true value of the company. Some analysts also do, even though, so I'm not sure if I'm clear, but if I'm not clear, just please feel free to just tell me the Q&A chat. I'll just try my best to answer you as well. But some analysts do also, they do the residual income valuation model. What the residual income valuation model does, that some analysts actually like to do is, it looks at the cash flow, but it takes into account the cost of capital. So is a more robust metric. Again, for different companies, you use different metrics. So it's not like one metric is better than the other. But the metric in which you use to evaluate the company again depends on what counter it is. You won't use, for example, you won't use dividend yield on C Limited. Those C Limited, elaborate later a little bit. But you won't use dividend yield because obviously C Limited don't use dividend. They don't even distribute dividends. So if you want to use dividend yield on C Limited, then it will not be relevant. So what is this rule of 40? What the rule of 40 does, I think like we have one participant who mentioned sometimes for this growth companies, looking at the net profit alone or the EBITDA margin, EBITDA alone is not reflective of the true value of the company. And why is that? Because they are investing a lot in Capex, and some of these companies, some of these growth companies, and the semiconductor industry, because in this growth phase right now. So we find the rule of 40 applicable to them. But what it does is it tries to balance between the revenue and the EBITDA margin. I appreciate I'm not be so clear, so I try to spend a little bit more time on this. But what companies like C Limited do, what companies like Grab do, is sometimes they invest a lot in the early years because they are trying to get customers. So for them, they invest a lot in sales and promotion, sales and marketing. They spend a lot in R&D expenses. They spend a lot on recruitment in the near term. So in the near term, for them, they'll be spending a lot of money on these kind of things to drive their revenue growth rate because they need to scale. Companies like WeWork, all of these guys, when you want to evaluate WeWork or you want to evaluate Grab, and then you look at net profits, you won't see, it's not meaningful. You just see a loss. So the question then is, how do we balance growing revenue and also balancing your bottom line? Because revenue growth is important because it gives you the scale, it allows you to grow over time, and hopefully when you're able to grow your revenue over time, you'll be able to generate profits in the long term and become sustainable. But the question then is, are you able to grow your revenue, but and you're able to grow but still survive in the long term? Because if you keep investing in growth, keep doing sales and promotion, and then you keep sustaining a loss, then the going concern of the company, whether they're able to continue to operate, becomes a concern in the future. And if they don't receive funding, then they may actually even go bust. So that's the concern. So what's the rule of 40? The rule of 40. The rule of 40. Sorry, maybe let's go back to. Let's see if we can go back to the previous slide. Okay, never mind. Yeah, so what it does is it tries to balance your growth of revenue and your EBITDA margin to be above 40. So if you're able to grow your revenue but keep a cap on your cost above 40, then at least in the long term it's more sustainable. But of course, if it's lower than 40, then there's an issue of whether you're able to survive unless you have very good backers. So what the rule of 40 does is it provides a high level view of SaaS companies. It was actually initially used to evaluate this software as a service company for software or this software business health, because they are growing, so they don't have a lot of this kind of profit to talk about. So they just see if you're able to strike a balance between trying to pursue revenue growth and then incurring growth expenditure. Of course, they hope to keep incurring growth expenditure. The question is, can you keep incurring growth expenditure and then still survive and then not go bust? Which is a very common trajectory for at least those startup companies. And I think some of you already know, so you already pointed out that if you continuously invest in sales, promotion, and Capex, sometimes you may just they may actually go bankrupt. So but they try to strike a balance between both. If they're able to cross the hurdle above 40, then we say that this business may actually be more sustainable or more investable. Of course, you all hear me talk, you all may not even know. So we provide some case study here so that you all better understand how the formula works. So the first case study is on Palo Alto Network. This is not a semiconductor, but we just give you an example. So Palo Alto is an American multinational cybersecurity company. For the benefit of those who don't know, with headquarters in Santa Clara, California. Its core products are a platform that includes advanced firewalls and cloud-based offerings that extend those firewalls to cover other aspects of security. Maybe a bit long, but basically it's a cybersecurity company. We provide some of the financials here. Sorry, it looks a little bit small on the screen, but I'll actually show the numbers lah. So how do we use the rule of 40 to calculate? So you see here when we use the rule of 40 formula. Sorry, I appreciate it's a bit small, but if you all want the slide, I think we have a team that provides the slides. So if you have the slide, you'll be able to see. But again, how we use the formula, we have revenue growth, and then you sum up the EBITDA margin. So when you look at the revenue growth, you look at the latest year, financial year 2020, revenue growth 17.5%. And then you sum up with the EBITDA margin. Again, the EBITDA margin is here 3.6%. Then when you sum these two up, you realize it's actually just 21.1%, 17.5% plus 3.6%, 21.1%. So in this case, we say it failed to cross the hurdle, even though your revenue growth is quite impressive, 70.5%, but your EBITDA margin is just 3.6%. So it doesn't pass the rule of 40 formula. So in this case, we're not won't be so keen. The next example, just two examples in case, just to make it better for everybody. We look at C Limited. So some of you may be familiar with C Limited. C Limited is a consumer internet company. The company has developed an integrated platform consisting of three main business segments, really. Digital entertainment, electronic commerce, and digital financial services. So the company operates three main businesses. Some of these are more prominent. Garena, Shopee, and C Money. Again, sorry, because of the size of the screen, so it may not be so clear, at least the numbers here. But when we look at C Limited, we look at the revenue growth just using the formula. The latest year, financial year 2019, of course now we have 2020, but 2019 revenue growth, their revenue growth actually surged 163.1% in FY19. And then you sum the EBITDA margin. So for C, here is where it's a little bit interesting. You can see their EBITDA margin is actually negative 33%. And why? Because they invest a lot on their Shopee platform. For those who are following, who know, sorry, that's just a little bit brief on C, because it's not a presentation on C. But for those who follow C, you all will know that obviously they invest a lot on their Shopee platform. They do a lot of advertising. Of course, if you get people like Cristiano Ronaldo down, then obviously you need to spend a lot. But because they spend a lot on sales and promotion, advertising, and all that thing. So their EBITDA margin is actually negative 33%. But in this case, because their revenue growth is so high, 163.1%. In fact, for 2020, it's about 123%. But because their revenue growth is so high, when you sum it up, of course, 163.1% plus the negative 33% gives 130.1%. We say that C Limited actually crossed the rule of 40 hurdle. So the way we look at the rule of 40 is the 40% mark is the hurdle rate. So are you able, is the company, maybe you are going very fast, but are you able to cross the hurdle? Because if you're able to cross the hurdle, it means that then you strike a balance between growing your revenue and also keeping a lid on cost. You want to, if you blow your cost 200% negative EBITDA margin, then it's not sure how long your shareholders are willing to sustain that kind of growth for you. So when we use the rule of 40 to calculate the metrics, what we do is we modified it a little bit, especially from the research department. What we do is we modify the 3-year revenue growth rate. Some of you may wonder why, but the reason why we modify the 3-year average revenue growth rate is because the 1-year revenue growth rate can tend to be a little bit more volatile, especially for some of these software as a service company. You look at Zoom, you look at Top Glove, you look at UG Healthcare, the revenue growth in 2020 actually surged, some of them 1,000%. So it's not reasonable to use a 1-year revenue growth rate. So we call it the rule of 40 modified. This is our own internal modification. You probably can't Google this, but what we do is we use the 3-year average revenue growth rate. And why is this important? Because later when we evaluate the semiconductor companies, we use the 3-year revenue growth rate in contrast to the 1-year revenue growth rate. So again, that's to preempt. So some of you may be wondering, did we use the 1-year revenue growth rate to calculate the rule of 40 calculation for this semiconductor company? The answer is no. We use the 3-year average revenue growth rate because we believe it smoothened out the average revenue growth rate over the years and reduce that kind of volatility for these companies. And of course, what we do also is to expand the rule of 40 calculation to evaluate beyond just the software as a service company and just evaluate some of these growth companies. And in this case, very specifically, is the semiconductor companies. Also, just before we go on, just to promote a little bit. In the next few months, the research team, the group, will be using the rule of 40 to pick some of these growth companies. We will do one webinar at the end of this month. That will be a Cantonese webinar. So for those who can understand Cantonese can attend. Otherwise, we'll have one in August also to talk about how we use the rule of 40 to pick some of these growth stocks in the market. The research department also did a backtesting of the research methodology. We won't go through in detail because we don't have much time also. But what we found, I think later when you all have the slides, you all will be able to go and see this in detail. But what we found is that there is consistent evidence of outperformance amongst firms shortlisted by the rule of 40 across developed markets and industries. So companies that are able to cross the hurdle, when we did a back testing of the hurdle rate, companies that are able to cross the rule of 40, maybe let me see if I can go back to the slide. Companies that are able to beat the rule of 40 are able to generate better returns. But when the way we look at it is, we don't only want returns, we want to look at whether they're able to generate better risk-adjusted returns. So what we found, just to backtrack a little bit, what is risk-adjusted returns? Because it's like casino, you make a lot, but then you take so much risk, then your risk-adjusted returns very low. But when you look at risk-adjusted returns, is for every unit of risk, how much returns you get. Of course, the best is you take a small 1% of risk, then you get 100% kind of returns. So we want to look at, for every unit of risk, are you able to generate an even higher level of returns? And that's what we found with the rule of 40. Because on a 3-year annualized returns basis, traditional metrics for stock picking, what we found, like profitability, people invest, they say, oh, let's invest in low PE, low PB stocks, price to earnings, low price to book stocks, low price to sales. Those low ones actually don't generate the returns. In fact, you look at here, the profitability metric, if you invest what we call here list C, again, because of time, we can't go through in detail what all these things are. Again, if you want to know, you can just reach out to me, because we have a lot to cover today. So just apologies because we cannot cover all. But if you invest in low PE stocks, your return is actually just 14.9% on a 3-year annualized basis, compared to you choosing companies that beat the rule of 40, about 58.4%. Firms shortlisted with the rule of 40 generated higher than average risk-adjusted returns. Again, for those who look at that, you all will see. And then the fourth point we just skip because we don't have time already. So we go to the semiconductor stocks. So for those of our investors who want to look at what stocks to pick in the industry, and also if for those who maybe feel just too confusing or just too many to pick, then we also have some ETF for you guys to pick as well, and for you all to choose and see to get exposure. ETFs, of course, will give, they're just broader, just ride the trend only. Yeah. So TSMC, that's for the benefit of those who don't know. TSMC is the world's largest semiconductor or foundry company, and also they're the world's biggest. Like some of you all see 57% market share also, and the pioneer to the pure play foundry business model. So they focus solely on manufacturing customers' products. Its services include wafer manufacturing, probing, assembly, and testing. And its integrated circuits are used across the electronics industry. So we have some key operating metrics here. They have a market capitalization of about $549 billion. In terms of PE, they are trading about 28.2 times now. We can see very, very strong operating margins, 67.1%. And then in terms of the rule of 40, they soundly beat the rule of 40. That's just easily crossed. And why? Because you see already the operating, which is very close proxy to the EBITDA margin, really 67.1%. So when you look at the rule of 40, they easily cross the hurdle. So in this case, you can see it's a very, 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 very strong company. But again, just to recap, I know maybe first for the benefit of those who just join us, when we calculate the rule of 40, we use the 3-year average revenue one, not the 1-year one. The investment merits we see, we listed 3. Obviously, there are more, but we listed 3 of the most important ones. they are obviously the market leader in the industry. We see TSMC is the market leader. In fact, the market share over the second one is over 20%. And going forward, we expect them to continue to win market share in the advanced node segments, especially in the 5nm and the 3nm, 7nm, 5nm and the 3nm space. So that one, they continue to win market share there. And the space in which it operates in is in the strong structural growth areas in 5G and AI as well. Then there are limited suppliers in the market. There are only really two main players, Samsung and potentially, that's still potentially, of course, there's a very big chance that they can come in. Potentially, Intel also will be joining the foundry market space. So we provided a chart here just to show how we calculated the rule of 40 formula. So you can see in 2018, their revenue growth is 5.5%. 2019 is 3.7%, and then 2020 surged. Of course, because COVID, so the revenue surged 25.2%. So what we do is, instead of taking just 25.2%, we take the average 3 years, 2018, 2019, and 2020. And then we sum up with the EBITDA margin. You can see that EBITDA margin also actually expanded. We move on to the next foundry player, Samsung Electronics. Samsung Electronics is a very, very popular consumer company. It's a South Korean multinational electronics company. It manufactures a wide range of consumer and industrial electronic equipment and products such as televisions, digital cameras, cell phones, storage devices, home appliances, security systems, smartwatches, and computer products. And basically, you can see they manufacture everything. So let's take a short pause. Thanks. So Samsung Electronics has a market capitalization of $487 billion. They have a PE of 19.2 times. Of course, we also want to, like we mentioned, Samsung is not a pure play semiconductor company. For them, they do a lot of consumer products. So if you want to get exposure into Samsung Electronics, then just because of semiconductor, then not really. PE is at 19.2 times, operating margins 28%, and then based on the rule of 40, they actually don't meet the rule of 40. They're actually 27.7, so they actually miss the rule of 40. But for us, why we think Samsung Electronics, the investment merits for them is they are beneficiary of the tight consumer demand. Also, same as TSMC, because there's just two of them only. And then, of course, same as TSMC, strong structural growth in 5G and AI. Also, same. There are also just two. There is a duopoly essentially. Say the thing here, because of time, I think maybe I won't elaborate. But again, we use the 3-year revenue growth. Sorry. So the market share of Intel and AMD. The next company that we want to cover is Intel and AMD. And before we go into Intel and AMD, we thought it would be useful to just show the market share of Intel and AMD x86 CPUs in the last 10 years. So you can see in the last 10 years, Intel has always held a leading position. In fact, if you look at the average market share of Intel, it's about 80% of the chips, and you look at AMD, obviously is in the low 20% range. But in the last 3 years, especially in the third quarter of 2019, you can see the market share of AMD actually starting to surge. You can see the market share of AMD starting to climb versus Intel's market share. Correspondingly, Intel's market share, especially in the x86 CPU space, actually start to drop. The market share of Intel and AMD's x86 laptop CPU worldwide also start to drop. Of course, Intel is almost a giant in the laptop CPU space. But you can see in the last 10 years, the Intel's market share actually is about close to 90% market share, and then AMD actually only does about 10%, obviously. But you can see in the last 3 years, the gap is starting to narrow between the two players. And this has also obviously been reflected in the share price chart. What we do is we normalize the share price chart in the last few years, you can see because it's a little bit small again. Sorry, because the for Bloomberg, that's how they show it. No other way about it. So the white line here is of course AMD's share price in the last 5 years, and then the green line here almost looks like a flat line here, but this green flat line here is Intel. So you can see the discrepancy, almost 4 times the difference, the discrepancy between Intel and AMD. And the reason why AMD has been growing so strongly in the last few years, again, is related to the last two charts. Again, just to recap, because so going forward, AMD is expected to continue to gain this kind of market share. So there seems to be more upside for their share price. Again, we can't go in detail for each company because of time, but if you all want to know more, you all can just reach out to me also, because we can't provide a very detailed analysis of each company because of the time we have today. So AMD is a global semiconductor company. It is engaged in offering x86 microprocessors as standalone devices or as incorporated into an accelerated processing unit, chipsets, discrete graphics processing units or GPU, and professional graphics. Its segments include the computing and graphics segment and the enterprise embedded and semi-custom segment. So AMD has a market capitalization of $104 billion, have a PE of 68.9 times, operating margins of 18%, and then based on the rule of 40 calculation is 42.1. So for us, AMD, there are few key investment merits. Obviously, it's gaining market share, like what you all saw for the server chips against Intel, helped by advances at TSMC, because it is a fabless player. So they outsource a lot of these chips making to TSMC, which make large strides. So that's why they gain market share on at the expense of Intel. Of course, they're also in 5G and AI. And for recently, they also acquired Xilinx, the #1 provider of adaptive computing solutions. So this will expand AMD's rapidly growing data center business. So this all-stock acquisition of Xilinx will immediately be accretive to their margins, cash flow, and EPS. So the moment they integrate this, they will be accretive to all their cash flow and EPS already. Then also we talk a little bit about the fabless player, Intel, also going to foundry. So Intel, no introduction, but we just be very brief. They design, manufacture, sell computer components and related products. Their major products are microprocessors, chipsets, embedded processors and microcontrollers, flash memory, graphic network and communication, systems management software, conferencing, and digital imaging products. So really very big, market capitalization about 226 billion. But just trading at 12.7 times, so very low, because very mature business and also be losing market share. And then in terms of rule of 40, they have a 54.5. So for us, the Intel, of course, the investment merits is they already announced plans to compete in the foundry market, which is a positive. At least they get some control on this. So this will challenge the market position of the incumbents. But for us, the contribution again will be a bit limited when we only expect it by 2023 or 2024. And also they are going to address the concerns to fix the manufacturing problems. So again, this is a bit early to tell at this stage whether they will be able to fix this. Qualcomm is also another fabless player. It's a wireless technology company. For us, we cover some of the popular names. We can't cover all, but we cover some of the more popular names that we get a lot of client queries on. Yeah. So we're not able to cover all, but we try our best. So they engage in the development, launch, and expansion of technologies like 5G, and operate in 3 main segments: core, division, multiple access technologies, technology licensing, and strategic initiative segment. So it offer technologies used in mobile devices and other wireless products. So for us, what we like about Qualcomm is they can gain market share they are expected to gain market share in the higher end chips based in millimeter wave, wave frequency bands with the next iteration of 5G infrastructure and phones. For Qualcomm, they will be supported by the smartphone shift to 5G, especially because they're so plugged into 5G. And the new CEO, of course, there's always a concern, right? Because Apple is producing their own chips as well. So the new CEO is eyeing new inroads into the laptop market, a strategic pivot to diversify its revenue from smartphone. So if they go into laptops, at least they diversify their revenue stream from smartphone. So the key challenge will be Apple producing its own chips. Then another name is Nvidia. Nvidia focuses on personal computer graphics, GPU, and AI. Sorry, I'll just speed up because of time. So for those that know, they address four markets: gaming, professional visualization, data center, and automotive. So their offerings are the DGX AI supercomputer, Nvidia Drive AI's car computing platform, and the GeForce Now cloud gaming service. For us, the investment merits here is the acquisition of ARM will expand the areas of synergy beyond just mobile to data center, automotive, and IoT markets, which I think we have an earlier slide that show the growth in these areas. The ARM acquisition is also expected to complete in 2022. Of course, they are waiting for all the approvals worldwide. Some of the countries we see they will support. ARM's IP powers 90% of the world's mobile processors, smartphones with Qualcomm and Apple as major customers. The software licensing business is expected to be a meaningful contributor in the near future, and they see gross profit margins in the 75% range. So this software licensing is not something they've done before, but this software licensing is also a very small part of their business, but it's expected to be a big part of their business. And in when we do a meeting with the CFO during the results briefing, what they say is that in the future they could just split up the software licensing, so you can see very thick gross profit margin. Of course, in terms of P, is very expensive also now, about 83.2 times versus historical. But the rule of 40 they cross 62%. Sorry, this slide is repetitive. Then in terms of the semiconductor ETF space, for those who feel that that's too much, then you can look at some of these semiconductor space iShares or VanEck and SPDR, some of their top holdings. This one is an easier way to get exposure into the semiconductor ETF So we won't elaborate too much on this. We have some resources here for you all to better understand the rule of 40 calculation. So the rule of 40, if you want to know, we have some of these resources, or you can reach out to me. Then we can elaborate more on what this thing is for you, those who want to better understand. And then we have a page here also to share a thematic portfolio page to share. We have the URL link if you to get to this page here, world leaders with rule of 40. If you want to find out more, just feel free to reach out to me. Yeah, so I think that's the end of my presentation. Thanks for bearing with me for a very long presentation. So if you have any questions, just feel free to reach out to me on the semiconductor industry. I appreciate that it cannot be too detailed today also, and I may be a bit brief. But if you have any questions, just feel free to just send me an email or just text me. That's fine. Okay, so let's go straight to the Q&A now. We have one top question here. How are these semiconductor? I'll just read a question. How are these semiconductor benefits the Singapore semiconductor sector, such as AEM, ISDN, Franken, and UMS? So I think the growth in the semiconductor space benefits the whole, is a lifting of tide for the whole entire industry. But when we talk about AEM especially, because we go into individual stock picks again. Sorry, for individual stock picks we may not be able to cover all. But for AEM, because they are major customer, over 80 to 90% of their revenue comes from Intel. So if the revenue from Intel actually, the contribution from Intel actually fall, then the for AEM they may not be able to grow. Of course, for most of these players, they will be able to grow if they because of the rising tide in the industry. Yeah. Then for ISDN, Franken, UMS, we don't really have coverage of these Singapore counters, and also our presentation today focus on the US. So maybe we just go focus on some of the US companies that we spoke about. Is it a good time to enter TSMC at the current price? In our view, yes. For TSMC, for them, of course, the whole semiconductor industry is is rising. But for us, we see TSMC as the main beneficiary of this thing. Again, because they're in the advanced nodes space. Of course, your smartphone growth will continue to drive this, but the high performance computing will be the key growth driver for them. So for TSMC, we view them as the best. Of course, the best beneficiary of this. Of course, what are the concerns for TSMC? The concerns for them at this moment, of course, is the exchange rate because between the Taiwan dollar and the US dollar. Another concern obviously is the demand from Apple, one of their largest customers. But for Apple, the smartphone demand is really seasonal. So we expect this to pick up, especially in the second half for TSMC. So for us, we see again when you ask is it a good time, we see the growth of TSMC as being will be multi-year and will go all the way until 2023 and even 2024. Why, despite chip shortage, TSMC stock price has moderated? Of course, TSMC has when you say moderated, you mean moderated recently. So that's a fair valid point. I think the challenge for TSMC at this stage is of course the because of COVID-19 related disruptions, they haven't, some of their manufacturing actually was disrupted a little bit, and also the demand from Apple seems to have moderated a little bit. But again, those are seasonal. We see those as seasonal, and by the second half they will be able to ramp it up. And of course, the concern for them at this stage, at least for TSMC, is whether they will be able to ramp up capacity in the advanced nodes as quick as they want to be, or they say they can. So that is still the uncertainty at this stage. We go to the next question. Do you think the sharp rise in stock price of Nvidia had resulted in the stock being way too overvalued? If so, is it a good time to take profit and wait for pullback? Or yeah, so again, it depends on this question. Depends on your investment strategy. If you're holding, and also of course the time horizon. If you're thinking of just trading Nvidia, then obviously because of the strong run up in Nvidia, especially in the last couple of days, then you may want to wait for pullback before you enter. But if you're taking a longer term view, the way we view Nvidia is plugged into all the high growth segment space. So those high growth segment space, the runway is still very long. In fact, internally we expect the runway to be about 5 to 10 years at least. So Nvidia and all these companies have a very long runway. It's not like tomorrow we will stop seeing all these chip shortage disappear also. So for us, we see the runway as being very long for Nvidia, and the growth to continue. Yeah. Which semiconductor company has the largest exposure to automotive sector? So actually you mean, I think to be very specific, you mean the foundry players, right? So the in terms of foundry players, that would be like TSMC and those guys. But actually it's very diversified, and sometimes they don't even break it down for you. But if we were to estimate, it should be TSMC. It should be TSMC or Samsung. So they don't break it down. Yeah, is the share price of Nvidia pricing in acquisition of ARM? We think so. We think some of the recent run up is because of some positive news of the acquisition of ARM as well. I'll just speed up because there are a lot of questions here. But maybe we'll just take one question here on the rule of 40 again. Rule of 40, what is the hurdle limit again? Is it 30%? So rule of 40, the hurdle is 40%. It means, just to recap, if you add the revenue growth rate with the EBITDA margin, that has to cross or be above 40% in order to cross the hurdle. So if you cannot cross, then generally it's not good. But we also want to be very, very quick to stress the rule of 40 is only one metric used to evaluate these semiconductor companies. It's not the only metric. So you have to look at other metrics as well. Yeah, we have another question on the rule of 40. Does 3-year average growth rate include forecast revenues or just the latest 3 years revenue? So this is a very good question. The rule of 40 formula, we use the 3-year average revenue growth from a historical perspective. The reason why we haven't used the 3-year forecast one is because sometimes the estimations into the future can be a little bit uncertain. Of course, you can use we think the better metric to use is of course the forecast one, but that's only on the basis of being able to reliably and accurately forecast the 3-year revenue. If you're not able to reliably forecast the 3-year revenue growth rate, then maybe it's better to, then it would definitely be better to rely on the historical revenue growth rate. Because if you cannot forecast the forward one, then don't bother with the historical one. So anyway, I think I've run out of time for my segment. I'm really sorry that I'm not able to take all the questions, but thanks for bearing with me. And now pass on to the next speaker, Jay Jacob.